Oracle Corporation, stock ticker ORCL, is currently trading $115. They reported their earnings after the bell last night, and pre-market they are down to 105. Year to date, they are up around 37%, but if you take a look at the graph down here, you can see back in September when they reported the last time earnings, the stock was hit pretty hard after the software giant reduced the fiscal Q2 guidance below what the sell side was expecting. So you can see here the company reported earnings per share of 134 compared to the expected average analyst of 132 and revenue of 12.9 billion versus estimation of 13.05 billion for the second quarter. The cloud revenue totaled 4.8 billion compared to the estimate of 4.86 billion. I think this is probably the main catalyst that the cloud isn't really growing as fast as we see from some of the competitors. And in other news, the board of directors also declared a quarterly cash dividend of 40 cents per share. This dividend will be paid out in January. So as I'm recording before the market open, we want to take a note of this $105 per share and then move on with the intrinsic value calculation and stock analysis of Oracle. Now let's jump into the valuation metrics here on Seeking Alpha. You can see here it boasts a PE/4 ratio of around 20, which is above the 5-year average. So looking a little bit overvalued already here. But again, this hasn't updated with a new one, but still I think it'll be slightly overvalued. And if you compare to the S&P 500, you can see over the last year they are up around 41%, while the S&P 500 is up around 16%. Year to date still the same, 37% and 20%. And if you look at a longer timeline, 5 years for example, you can see here 147, almost double of the S&P 500. So historically, this would have been a very nice choice to at least buy 5 years ago. But it also offers a pretty nice dividend of 1.4% roughly, annual payoff 160. Very low payout ratio of 29%, a 5-year growth rate of just shy of 15%, and a dividend growth streak of 9 years. If we take a look at the history, you can see here they are exactly as we want to take a look at it, up and to the right. And I think they have a plenty of free cash flow to build this dividend up into the future and really exceed the sector average on payout, because they do have that very low payout ratio of just 29%. So bar any big catastrophes or anything, obviously, I think they should be pretty safe going forward in growing the dividend. And let's jump into the financial statements. You can see here in revenue-wise, they are up from 39 billion back in May 2019 to around 51 billion in the last 12 months. Scrolling down a little bit to the net income, you can see here that actually fell down a little bit. 11 billion back in 2019, now down to 9.3 billion. But let's jump into the cash flow statement as well. You can see here that income starts at the top, and then we scroll down a little bit to cash from operation. You can see it has actually increased from 14.5 billion up to around 17.8. But you also want to take a closer look at it had 1.6 billion in capital expenditures back then. Now we are almost at or above 8 billion. So definitely check into what these capital expenditures is, because if you scroll down here, you can see the cash flow, free cash flow per share sits roughly at the same. So they have probably also bought back some shares as well to keep this pretty steady. You can see a 3.55 back in 2019, 3.4 now, nice. So still plenty of room to grow the dividend into the future, but still not growing the free cash flow per share. But again, if you do share buybacks, for example, you can also grow the free cash flow per share that way, instead of growing your free cash flow or net income and cash from operations and capital expenditures. If those remain steady, for example, and then you reduce the shares outstanding, you still grow free cash flow per share, freeing up more free cash flow per share to actually grow and pay out the dividend. Before we jump into intrinsic value calculations, I do want to check how Wall Street thinks about Oracle at the current time. And you can see here they have it rated as a buy, pretty close to, or somewhere between hold and a buy actually. And if you take a look at the analyst breakdown, there are 34 analysts in the last 90 days, 13 on the strong buy side, 4 on the buy, 15 holds, so majority here, but still a couple on the sell and strong sell side. Coming down here to the price target, you can see they anticipate a roughly 10% upside from the current level, with the average being around 126. So still obviously a bit higher since the current price is around 105 as we saw earlier. But the lows is really low, around $76 per share. But let's jump into our stock screen and take a closer look at Oracle. So as you can see here, we do have earnings per share and so on and so on and so forth. And as you can see, the revenue growth, 5% CAGR over the last 5 years, actually looking pretty good. We are somewhere between the 52-week high and 52-week low. What I really don't like to see here is the net debt to EBITDA. You can see here a debt of almost $90 billion and not that much cash on hand. So a very, very high net debt to EBITDA ratio, especially for a technology company. Obviously, they are typically pretty leveraged, and with the high interest rates we see right now, I don't really want to see this. This is a major red flag in my opinion, at least. But I do really like the return on invested capital and return on equity on both. The way above the 5-year average for return on equity and roughly in line with the 5-year average for ROIC, which is really good. Margins are also looking really good. You can see a gross margin of almost 45%, a operating margin of 31%, which is really good. Obviously, it has not grown over the last 5 years, but still it's a pretty high operating margin, and a profit margin of 20%, also looking really, really good. The current yield, as mentioned earlier, around 1.3 payout ratio. This is based on free cash flow, and the other earlier one was based on earnings, and still pretty good growth rate for the 3 and 5 year averages. Let's jump into our smaller stock or dividend data tab here. As you can see here, what we want to see here is basically some steady growth. So taking a look at this table here. So instead of having like this with 1 year being 6% growth and the year before being 25% growth, I much rather prefer this being more steady, to be honest. So a 10-year growth rate of 20%, I don't think that is sustainable into the future. I think this 15% is probably pretty good now for the 5-year average, but I probably would like to see this a couple of more quarters before I actually probably deeply invest into Oracle, just based on this at least. And scrolling down to the dividend yield theory graphs, you can see here whenever we are below the red line, the dividend yield line into the red area, it doesn't really look like it's a big discount to be had at the current time. Also, it would show up here on the graph on the left. As you can see, not that long ago, it actually traded at quite a lot of discount, at least according to the dividend yield theory, but currently it seems to be a little bit overvalued. To support that, we also have a lot of other valuation methods, such as the dividend discounted cash flow model, the dividend discount model, the multiples valuation, the grams valuation, price to earnings model, the free cash flow valuation, and also the Peter Lynch model. Feel free to skip back into the video or pause at any time to see some of the estimates that I have done before we jump into summary. And lastly, before we go into the summary, I do want to thank you for watching the video. Please subscribe to the channel for more videos into the future. Now let's jump into the summary. So as you can see here in the summary, we do have all our valuation methods over here. I have excluded the dividend discount model because, as you can see, it is negative due to the growth rate of the dividend for Oracle. So let's exclude that one. It all averages up to around $100 per share. So the current price being $115 or $105 pre-market. The average current discount is between 5 to 15% over value. So we obviously also want to apply a margin of safety. To do that, we have our margin of safety calculator over here on the right. We start with a standard of 25, and then depending on some of the key metrics such as EPS growth, we either add or deduct a little bit margin of safety. And in this case, we end up with a margin of safety of 10%. So if we transfer that over here, you can see the margin of safety actually gives us an acceptable buy price of $90, which isn't too far off the current price. Personally, I think I wanted it to fall a little bit below the $100. I think the cloud gap between Oracle and Amazon Web Service is probably too big. So for me personally, I would need this to drop a little bit further because it probably is worth owning if it's at the right price due to the dividend growth and probably into the future when they are more competitive. I think currently the gap between the cloud services is a pretty big negative for the Oracle mode, to be honest. So for me personally, I would wait out a little bit, but I do think there are definitely some promising things coming out of this video, especially the dividend growth and that we are approaching this acceptable buy price, where for me personally, it would be probably somewhere between the 90 to 100 range. Thank you so much for watching, and I'll be seeing you in the next video.